Looking at securities exchanges, understanding the JSE in particular as a securities exchange, right? So the Johannesburg Stock Exchange is essentially the meeting place for the Johannesburg Stock Exchange is essentially the meeting place for people who need money and for people who have money. It is a meeting place for people who need money and people who have money, right? Companies and government come to the JSE when they want to raise long-term funding. This could be through selling shares or issuing bonds, right? Think about Discovery Limited deciding to expand its health insurance operations into new African markets. All right, let me start afresh. Understanding the JSE in a simple, practical way. So we are now on the section of securities exchanges. The Johannesburg Stock Exchange is essentially the meeting place for the Johannesburg Stock Exchange is essentially the meeting place for people who need money and people who have money, right? Companies and government come to the JSE when they want to raise long-term funding. This could be through selling shares or issuing bonds. Think about Discovery Limited deciding to expand its health insurance operations into new African markets. Instead of borrowing money from a bank, Discovery might issue new shares through an IPO, an initial public offering, or raise debt by listing a corporate bond. So Discovery, in order to raise long-term funding, can either issue shares through an IPO or raise debt by listing a corporate bond, right? On the other side of the transaction are institutions such as retirement funds, life insurers, and unit trusts, who are constantly looking for reliable assets in which to invest policyholder money, right? So if you are saving for retirement through your employer's provident fund, a portion of your contributions will eventually flow into the JSE so that your retirement savings can grow over time. In this sense, the JSE sits right in the middle of the long-term financial ecosystem, converting household savings into productive investment in the economy, right? And then there's primary and secondary markets. So the JSE has two big roles. First is the primary market, which is the place where new securities are issued for the first time, like when a business lists on the exchange or issues new bonds, right? A good South African example is when MTN listed years ago and raised capital directly from investors to expand its network. That money went straight to MTN. The second role of the JSE is to provide a secondary market, which is where existing investors buy and sell securities to each other, right? So in the secondary market, no new money goes to the company, but the trading activity gives investors liquidity, right? For example, if you want to own shares in Woolworths and you decide to sell them, the JSE provides a platform where someone else, maybe a retirement fund, can buy them at a fair real-time market price. This liquidity is crucial because investors would never buy shares in the first place if they knew they were stuck with them forever. So that is the primary market and the secondary market. provided by the JSE. A primary market is for new issues such as an initial public offering or issuing of new bonds. And then in the secondary market, no new money flows into the company that listed the securities. It is just the investors trading amongst themselves. So an owner of a particular company's shares, if they want to sell those shares, another investor who wants to buy, they can have a transaction through the secondary market. So what the JSE actually trades? The JSE handles a wide range of securities, but mainly it trades or it offers shares or equities, bonds and derivatives. Shares or equities, bonds and derivatives. It does not operate the money market. That's handled by the banks and short-term dealers. But it does facilitate trading in currency derivatives, equity derivatives, and commodities like maize, wheat, or even energy, right? So let us search what is a derivative. From my own understanding and previous education, if I recall, a derivative is an asset whose value is derived from an underlying asset. So an equities derivative is just a security or an asset class whose value will be derived from the value of an actual equity, right? Or of an actual share. So, but then let us ask Google, what is a derivative in financial, what is a derivative financial instrument? A derivative financial instrument is a contract between two or more parties whose value is derived from an underlying asset, benchmark or index like stocks, commodities, currencies, or interest rates. Instead of owning the asset, you are trading a contract whose price moves with the underlying asset. So a derivative is a contract that contract has value, and its value is derived from the underlying asset. So a derivative financial instrument is a contract between two or more parties whose value is derived from an underlying asset, benchmark, or index like stocks, commodities, currencies, or interest rates. Instead of owning the asset, you are trading a contract whose price moves with the underlying asset. It is used primarily for hedging risk, speculation, or accessing markets. The four main types are futures, forwards, options, and swaps. So those are the types of derivatives. You can have futures, forwards, options, and swaps. And they allow investors to manage specific financial risks without owning the primary asset. Right. So the key characteristics of a derivative, a key feature is that it has a derived value. A price of a derivative comes from something else. For example, an oil futures contract's value depends on oil prices, right? A stock derivative, the price of a stock derivative comes from the price of the actual stock, right? A bond derivative, the price of a bond derivative comes from the price of the actual bond itself. So the movements in price of the underlying asset or the primary asset will also affect the price of the derivative. So that's a key characteristic of a derivative. It has a derived value. Its price comes from something else. There is no ownership. You don't own the actual asset. You just own the contract. There's leverage. It often involves leverage, magnifying potential gains or losses. Future settlement, it involves future delivery or cash settlement. So the common types, as we've said, is futures, forwards, options, and swaps. Futures obligates you to buy or sell an asset at a set price on a future date. Forwards, similar to futures, but traded privately over the counter. Options gives the right, but not the obligation, to buy or sell an asset. So with options, you have the option to buy or sell, right? With futures, you are obligated to buy or sell. Depending on what the contract says, you are obligated to buy or sell at a certain price at a future date. With an option, you have the right but not the obligation to buy or sell an asset. And then swaps, exchange one stream of cash flows for another. Interest rate swaps. Okay, that one not that clear. What is a swap? Let me ask what it is a swap. What is a swap? In derivatives or in financial markets, what is a swap? In financial markets, a swap is a derivative contract where two parties agree to exchange swap streams of cash flows or liabilities from different financial instruments over a set period, typically used to hedge risk, speculate, or get better financial terms, with common types including interest rate swaps and currency swaps. These are customized over-the-counter agreements not traded on exchanges based on notional principal amount. How swaps work: exchange of cash flows. Instead of exchanging the actual principal, parties exchange payments based on that principal. For example, one pays fixed interest, the other pays floating interest. Customization. Terms are negotiated directly between counterparties, allowing for tailored solutions to specific financial needs. Notional principal. The underlying principal amount used to calculate interest payments, but it's not exchanged. All right, so not to get into details, but was just highlighting that in the JSE, the main securities that are traded is shares or equities, bonds, and derivatives, right? So, and we said that the JSE does not operate the money market. That's handled by the banks and short-term dealers, but it does facilitate trading in currency derivatives, equity derivatives, and commodities like maize, wheat, or even energy. For example, a farmer in the Free State may use JSE commodity derivatives, which come from the old SafeX, to lock in a maize price months before harvest so that he is protected if the maize price crashes. Similarly, an insurer managing interest rate risk on its liabilities might use JSE interest rate derivatives to smooth the impact of interest rate volatility. So the JSE's different markets: equity, bond market, and derivatives markets. The equity market is the platforms. I think it's platforms that they're talking about here. The main board and AltX for the equities market, and then the bond market. All right, I'll come back to this when I look at the notes. How the JSE functions as a marketplace. Imagine the JSE as the sentient version of a highly organized, rule-driven mall where people come to trade financial products. You can't walk in and trade directly. You need a broker. Just like you would need a real estate agent to buy a house, a client places an order with a broker. The broker routes the order into the JSE's electronic trading system, and the system matches buy and sell orders automatically. So the main equity system, MIT, works like a digital order book where the highest buying price meets the lowest selling price, right? All right, I think we need more context around this sentence. Let me open a new window and prompt ChatGPT, right, and say, please explain this specific sentence from this paragraph. Please expand on this sentence. Please expand on this sentence so that it's easier to understand. Yeah, this part about the MIT. Okay, so the main equity system called MIT works like a digital version of a price matching board. It keeps track of everyone who wants to buy shares and at what price, as well as everyone who wants to sell shares at what price. The system constantly compares these buy and sell orders and automatically matches the highest price someone is willing to pay with the lowest price someone is willing to accept. This way, trades happen quickly and fairly, and the market always shows the most accurate current price for each share. Right? Give an example. Right, so here's an example. Imagine you want to buy shares of a company called ABC Limited. You are willing to pay 50 Rand per share, and someone else wants to buy at 48 Rand per share. At the same time, they are sellers. One wants to sell at 52 Rands per share, and another wants to sell at 50 Rands per share. The MIT system looks at all the buy and sell orders. The highest buying price is 50 Rands. That's you. And the lowest selling price is also 50 Rands. The seller is willing to sell at that price. So now the system matches you automatically with that seller, and the trade happens at 50 Rands per share. Right? So the highest buying price and the lowest selling price. So the highest buying price in this case is 50 Rands. The lowest selling price is 50 Rands. So orders that don't match immediately, like the buyer at 48 Rands or the seller at 52 Rands, stay in the system until someone else is willing to meet those prices. So this process ensures that trades happen fairly and transparently, and the share price you see reflects the price people are actually willing to buy and sell at. Okay, makes sense now. So that is the MIT system. Imagine the JSE as a Santin version of a highly organized, rule-driven mall where people come to trade financial products. You can't walk in and trade directly. You need a broker, just like you would need a real estate agent to buy a house. A client places an order with a broker. The broker routes that order into the JSE's electronic trading system, and the system matches buy and sell orders automatically. The main equity system, MIT, works like a digital order book where the highest buying price meets the lowest selling price. This creates an efficient and transparent price discovery process, which is essential for markets to function. Bonds and derivatives trade on a different system called Neutron through the JSE, though the JSE has been working towards consolidating these platforms for simplicity and efficiency. Right. Now, how does the JSE regulate the markets? What many students don't realize is that the JSE is not just a trading venue, it is also a regulator. It has to protect investors by making sure brokers behave properly, companies follow strict reporting standards, and trading is monitored for insider trading or manipulation. For example, if a sudden price spike occurs in Sasol shares minutes before a major announcement, the JSE's Market Regulation Division investigates whether someone traded using confidential information. They also ensure that companies that want to list must meet high standards, such as publishing audited financial statements and following continuing disclosure rules. This protects investors, especially retirement funds and life insurers, because they rely on accurate financial information when choosing investment assets that ultimately support policyholder obligations. And then clearing and settlement. Clearing and settlement. What happens after a trade? Let me take a sip of water. So, clearing and settlement. What happens after a trade? Once a buyer and a seller agree on a trade, the next step is to actually transfer ownership of the security and move the money. This sounds simple but involves very robust systems to avoid fraud. It sounds simple, but it involves robust systems to avoid fraud, defaults, or delays. In South Africa, settlement happens on a T+3 basis, meaning 3 business days after the trade. Straight, the Central Securities Depository, handles this electronically. For example, if Allan Gray buys 20 million rands worth of government bonds, Straight ensures that the bonds move from the seller's account to Allan Gray's account, while the cash moves to the seller's account. Right? The bonds will move from the seller's account to Allan Gray's account, and the cash will move from Allan Gray's account to the seller's account. Right? Because Straight is owned partly by the JSE and the major banks, it functions as an independent, trusted infrastructure. This efficient settlement system is one of the reasons international investors are comfortable investing in South African markets. How the JSE provides market information. Market prices on the JSE are public but not instantly free. Live data is expensive because it's valuable for traders and investment professionals who rely on real-time updates to make money. Retail traders usually see a 15 minutes delay unless they pay for live access. Commercial data vendors like Bloomberg and Reuters package this data with analytics, history, charts, risk measures, and sector indices. For example, the JSE All Share Index summarizes how the overall stock market is performing and is used by actuaries when modeling long-term return assumptions or when evaluating equity risk premiums for valuation work. These indices are updated regularly to reflect new companies, reweight sectors, and improve the accuracy of their representation of the economy. Alternative exchanges. We have the Cape Town Stock Exchange and A2X. In the last decade, alternative exchanges like the Cape Town Stock Exchange and A2X have emerged. They aim to increase competition and reduce trading costs. For example, A2X allows dual listings, meaning a company like Naspers can trade on the JSE and on A2X simultaneously, giving investors more options and sometimes lower fees. This competition benefits investors by lowering transaction costs and giving companies more flexibility in how they raise money. The Cape Town Stock Exchange focuses more on smaller, growing companies that may not meet the JSE higher listing requirements, giving South African SMEs an easier path to accessing capital markets. All right. So that is the securities exchanges, the JSE. So the JSE or the Johannesburg Stock Exchange, it was known as the JSE Securities Exchange for a while, but now it is back to the original Johannesburg Stock Exchange. It is the main securities exchange in South Africa and has two key roles: raising finance for companies and governments via the primary market or new issues market through initial public offerings or IPOs, and then providing a secondaries market for investors, as we have explained. Now, the JSE brings together lenders and borrowers, and then the main lenders are usually retirement funds. Lending in this case means buying securities that are listed on the JSE. So if a company listed shares on the JSE, a lender would be an entity that buys those listed shares because it moves money from its account to the JSE's account to buy those shares, and then from there the company that listed the shares has now access to that investors funds. So JSE is where buyers and sellers meet. So the lenders buy the listed securities. The main lenders on the JSE are retirement funds, life insurance companies, individuals, non-life insurance companies, collective investment schemes, investment companies, and trusts. So these lenders can buy listed securities. We said that those can be equities, they can be bonds or derivatives. So the securities that are dealt on the JSE are equities, bonds, fixed interest securities, as well as derivatives. Right. And then we said the JSE does not operate or facilitate any money market transactions, nor does it cover any foreign exchange transactions. Right. But it does trade currency derivatives. And then the markets. We said the JSE connects buyers and sellers across a number of markets and platforms. Equity products, including warrants and ETFs, among others, are offered on the main board and the AltX, the alternative exchange for smaller companies. The main board and AltX, those are the platforms for equity products. And then for debt or fixed securities like bonds, that is the debt market. This one covers government bonds, corporate bonds, and the repo market. It includes the old bond exchange of South Africa, BESA, BESA, Bond Exchange of South Africa, which was bought by the JSE in 2009. Right. So what I'm getting from this is that before 2009, there was an exchange specifically for the trading of bonds, the Bond Exchange of South Africa. And then this was acquired by the JSE in 2009. The debt market. So that is for the debt market. The equity market, we said there's the main board and AltX, alternative exchange. And then the derivatives market include bond, interest rate, equity, or commodity derivatives and currency derivatives. It includes the old SafeX, which was acquired by the JSE in 2001. I assume SafeX is where derivatives are being traded, is a platform for the trading of derivatives, but it's part of JSE. So the roles of the JSE includes providing a market, regulating the market, settlement of trades, and providing investors with information. So in providing a market, a market is a place where buyers and sellers meet. They come together to trade according to the rules of the market. The majority dealing is done by clients through one of the many member firms, the brokers. And then the brokers buy and sell shares on the instructions of their clients. And then all trades on the exchange must be routed through the broker. And then though there are many ways of accessing a broker, including online trading platforms, equity trades are routed through the order-driven system, the MIT system, which stands for Millennium Investment Technology, the MIT system. This one is for facilitating the transactions, matching buy and sell orders for equities. And then bonds and derivatives are traded on Neutron, and the JSE is aiming to bring all trading onto the same system in the near future for effectiveness and efficiency. And then the JSE also has a role of regulating the market. It is governed by the financial markets. The JSE is governed by the Financial Markets Act. So, and also the FICA, the Financial Intelligence Center Act. So these acts gave the JSE the responsibilities as of a market regulator. So the regulatory activities undertaken by the JSE Market Regulation Division include the monitoring of trading activities in the different or various JSE markets to identify possible market abuse and oversight of the brokers' compliance with their regulatory obligations. So brokers, if they manipulate prices, and then if the traders abuse the markets through insider trading, all those things are regulated by the JSE. It is the JSE is responsible for ensuring that the market is fair and effective. It is responsible for ensuring that business takes place in an orderly manner and that the investors are provided the necessary protection, and by regulating the brokers, by regulating the transactions, and by regulating the companies that are listed. So the brokers have to follow the rules of the JSE, which cover trading practices and professional standards. The transactions of the JSE mean that the price, the time, and the volume of all the trades have to be reported soon after they occur. This reporting means that it is possible to check whether the transactions have been properly carried out or whether insider trading or may have occurred, right? And then the companies that wish to list their securities on the JSE, they must meet the requirements for listing, including proper reporting requirements, having audited financial statements, publishing financial statements on time, being transparent, continuous disclosures, all those that are the listing requirements. And then all these regulations provide confidence, give confidence to investors so that they can trust the integrity of the financial markets and the JSE. And then another role is the settlement of trades. When one investor has agreed to sell or buy a security from another investor or a market maker, the registrar needs to be informed, the share or bond ownership needs to be transferred, and money needs to change hands. Right? This administrative process is known as clearing and settlement. Clearing is the process of preparing the trade for settlement and allows the member. So clearing is the preparation of a trade, and it allows the member on both, and it allows the members on both sides of the trade to ensure that they or their clients have securities or the cash ready to settle on settlement date. And then settlement for both equities and bonds takes place 3 days after the execution of the trade. This is the T+3 we spoke about. And then settlement is normally conducted through Straight. Straight is a company owned by the JSE and the major banks. It is owned, so Straight facilitates the transactions, the settlement of the trades is concluded through Straight. And then Straight is a company that is owned by the JSE and the major banks that act as a central securities depository and provides an efficient electronic settlement system for the transactions. And then another role of the JSE is providing investors with information. The JSE also publishes information which may be of interest to investors, this being a significant revenue stream for the company. While share trades are considered public information, this information is delayed by 15 minutes and the live prices required by the market participants are expensive. So accessing live data of like share prices or securities prices is very expensive, I think, and the trades or the prices of securities listed on the JSE that are public are delayed. That the information of the prices of listed securities that is available for free is delayed by 15 minutes. So all right, I think I'm gonna skip this part. We've gone through it. On alternative stock exchanges, so that is the Cape Town Stock Exchange and A2X. Now the advantages of having alternative stock exchanges, not just the JSE, is that it gives companies flexibility to list their securities on various exchanges, and this boosts liquidity because they can list their securities on various platforms. It means now their securities are more accessible, more available for investors, and the flexibility comes from that these other exchanges may not be as strict in terms of having securities of a company listed, may not be as strict in terms of their requirements for listing securities. So this one, that gives an advantage to small and medium enterprises who may not be able to list easily on the JSE. So now they have they can go to an alternative stock exchange. So there are a few stock exchanges in South Africa which offer similar services and products to the JSE. Those are the Cape Town Stock Exchange and A2X. The advantages of new exchanges include improved offerings for the market, lower costs, and lower barriers to entry for companies wanting to list. It gives companies opportunities to list on multiple exchanges, which can allow for more ways to raise capital and improve liquidity. Right. And that concludes our session on the JSE or the securities exchanges.